talking about a topic that I've been excited to really dig into.
Online for free. We just have it in real time. So the mortgage-backed securities, the more green there is on those, that means the more desirability there is to purchase mortgage bonds. So simple supply and demand, when mortgage bonds are desirable, rates go down to create more supply for that demand. And the other way to really track it without diving into mortgage-backed securities is the 10-year treasury. And I'm going to try not to move around that much, but right now we're seeing today that it's probably going to drop below 4, and we haven't had that in a while. I put this up as a 5-year chart. So the lower the 10-year, the more favorable rates are. Right around here is COVID, when the 10-year was almost at 0. And that's when we saw, like on VA loans, 2.5, 2.75% rates, and on conventional, those low 3s. So you can see it's been very volatile for the last year because of inflation data and everything that is tied to that. I'll bring up another picture here, which actually shows what controls interest rates. But from just a day-to-day for your client's perspective, you can always watch the 10-year. The lower it goes, that normally is better for interest rates. And the big reason why that controls it is the stock market is taking a dive today because of the tariffs. I think it was down 1,200 points last time I looked. And what that means and why you should pay attention to that as well is when the stock market's volatile and going in the negative direction, investors will go to what is called a flight to safety, and that's bonds and mortgage-backed securities. So that's why you see the 10-year during the COVID times was so low, because oil was dropping, the stock market was dropping, GDP for the country was. So the flight to safety was secure investments, government bonds, and mortgage-backed securities. And that kind of leads me into what controls interest rates. A lot of people think it is the Fed. I'm going to skip down one. The Fed does have an impact on what controls interest rates, but they control what is called the overnight exchange rate, or your consumer rate, meaning when they lower the rate like they did a couple of times last year, that's more along the lines of what goes into the prime rate, your credit cards, lines of credit, everything like that. It doesn't always have a direct impact on what the mortgage market does. However, the mortgage market's going to follow the trends of the normal market. So yes, Federal Reserve decisions and statements do make a big difference. And I want to focus more so on the statement than the decision. So right now it's indicating that the Fed is not going to do any rate cuts this year. Last year, we did see rate cuts towards the end, and it actually had an inverse impact on mortgage market where the rates actually went up a little. But right now, with them not making any changes, we're seeing a subtle decline in interest rates. And the reason I said focus on statements is the Fed will make their decision, but the biggest thing is when they put out their monetary policy, and when we'll see the most impact on those is the Fed meeting weeks, when the Fed chair, Jerome Powell, actually gets up and does his speech and press conference after the decision's made. Because we've seen the market almost reverse when that happens. Like they'll make their decision, we'll see maybe trending down or upwards. And then when Jerome Powell talks, it gives a general idea of where basically the Fed's head is at, and that dictates more of what's going on in the market. And then the other thing, of course, what every economist and Federal Reserve member has been hanging their hat on for over a year is inflation reports. There's lots of different inflation reports. They break them down into consumer price index and just overall cost of goods and everything like that. That's more of a deep dive review. I don't even go that deep as a mortgage professional, but you can look up when these reports are coming out. And the biggest thing when you look at those inflation data reports and how it impacts the market and what the Fed's decision making is what their forecasted data is for inflation versus what it actually comes in at. So if we're trending in the right direction, that's good for everybody. But if inflation, they'll say, came in hotter as the industry term, meaning it was more than what was expected, that's when you'll see the mortgage rate market react negatively because their mindset, and I don't know what the philosophy is behind it, to be very honest, is the higher the rate, the more they can control inflation. I know they're trying to control spending and everything like that, but that's part of the reason why rates went up was to control inflation, slow down the demand for certain products. And unfortunately, it impacts our buyers when it comes to qualifying and everything like that. Because one of the main reasons why rate is so important is we're now in a time where, due to inflation, cost of living, as we all know, has gone up. Two, interest rates go up and it increases the affordability for a property. And we've seen taxes and insurance go up across the board. Taxes are being reassessed because values have increased all over the state of North Carolina and everywhere. But we're seeing, like I live in Wake County, there's a huge increase. Johnson County had that issue. Cumberland County has also seen increases as well. So you factor that in with rates and insurance costs going up because all the natural disasters, we all get impacted by that when the overall pool of insurance becomes more expensive. So it's not doom and gloom, it's more along the lines of working with the right professionals, both on the mortgage and real estate and even insurance side, because I've seen insurance vary dramatically between companies to make sure that the client understands affordability. Because we are starting to run into where people are getting capped out at affordability, but even the well-qualified people have their own personal budget. And that's where one of my goals come in is they'll say, what's the max I can afford with this interest rate environment? I'll say, well, here's the max you can afford, but let's talk more about what your family's budget is. Because what I say on guidelines and what your personal budget is are two different numbers. So let's build around that. And that's why it is important to watch rates because you have people that sit out on the sidelines, rates are too high, etc. Well, as they start to tick down, I try and re-engage those people, and the agents that I work with re-engage those people, say, hey, we're getting more affordable. And sorry, went off on a little tangent there, but yeah, inflation, Fed decisions, jobs report is a big one. GDP does have an impact, that's gross domestic product, where what our overall US economy's doing, but not so much. And then we briefly talked about bond and treasury yields. Yeah.
When you say the jobs, you're talking about employment?
Yes,
Okay.
unemployment. So, at the beginning of each month, they'll do how many jobs were added to the US economy. So that's a little trickier because sometimes unemployment will go up the percentage, but it'll have a positive impact because we added what was the correct amount of jobs according to what the government wants to see, adding jobs each month.
Okay.
So yeah, the jobs report does have a big impact. The only thing with the jobs report, and it's very frustrating for anybody in our industry, is we pay attention to it obviously because we want to forecast what's best for our clients, especially we have rate marks for people that might be ready to refinance because people did buy when rates were high, which is good because as we know, property values are appreciating, but we monitor when is a good time to basically pull the trigger on a refi. So that's why we pay attention to this to help those people with affordability. And last year, as we watched it, the jobs report was amended, if y'all remember, like 6 times, I think maybe more. When it was all said and done over a calendar year, they said they over-reported 960,000 jobs, which stinks because when they do those amendments, it doesn't have the same impact as those monthly reports do. Like, oh, we overcalculated, we got to revise this down. Well, the immediate knee-jerk reaction when that first incorrect report came out was, negative to rates. We don't see that taking down. But I think overall the powers that be that put those reports together did a better job to make them more accurate. And then, of course, housing markets also have an impact, as you all know, supply and demand. And then the bottom one is just consumer confidence, which it is what it is, sounds like. It's how confident are US consumers in this market to go out and purchase large items, homes, cars, just anything in general, take vacations. I had an economist say that the best indicator for how the economy is actually doing is go to the airport and see how busy it is with people traveling not for business. It's like that's actually a great way to look at it, because what's the first thing people are likely going to cut if they have to their vacations? Because you can't cut your mortgage, you can't cut food, can't cut fuel to go to work and eat your house. So that, and I was like, that's actually a great, he said, well, amateur way to look at it. And so that's another way to look at the overall economic climate is even in the if the economy's not doing well on paper, people still out there spending. And the other side of that is, are people out there spending, but are they spending on credit? Because we're over $1 trillion of credit card debt for US consumers, which is insane because people are sometimes living beyond their means, or they're unfortunately using credit to just get by every day. And that's the other impact of why rates are so important, not just mortgage, but when it comes to consumer rates, because credit cards are like 20% right now. So these people are living on credit cards, and unfortunately, they're barely just paying the minimum interest each month and not attacking that debt.
You could tell me if this is too soon to ask this, but I have been asked, and I don't know if you've been asked this. I've been asked this multiple times by potential buyers. Like, is the market going to crash? Is the market going to crash? If I get asked that one more time, I'm like, what? I'm trying to figure out where they're getting that from. Have you been asked
I've been asked
about
that.
the market?
It's always not, because I don't know.
I've been asked that. The best way I always explain it is, let's look at data, because data, if it's reported correctly, does not lie. And I'll see if I can find the chart, but you could probably either ChatGPT it or Google it. Look at the housing value record all the way back to the 60s. There's only twice when we had more than 2 consecutive years house prices declining. The first time was when we were in a recession in the late 80s or late 70s into the early 80s, and the second time was 2008, the housing crash. And the 2008 housing crash, that was propped up by, as we all know, values that were well over where they should have been, and mortgages that should have never been written. I wasn't there for those days, but I still had to learn about them. So, I mean, we're seeing, if you look at the housing record, probably in the past 4 or 5 years, you're not seeing the crazy appreciation, but in North Carolina, at least, it's still averaged like 4.9% was the last time I looked at it. Like in the COVID days, in certain areas, like in Charlotte and around Raleigh and everywhere else it was, we were seeing like 18 to 20%, which is unsustainable and kind of nuts. But that long-winded explanation of, is there going to be a crash? I mean, nobody knows at the end of the day, but if you look at literally like a 60-year housing record, there's no indication of it doing like a true crash. The last one was 2008, but there was forced outside things there because of the market that banks, everybody created, which was dumb. And the other thing is, when it comes to answering that question as well, is what it's very area specific. Like we're in Fayetteville right now. As long as Fort Liberty, Bragg, whatever they call it now.
They just brag again.
It is Bragg. And we still have PCS season and everything down here. There's always going to be housing demand, because I've helped plenty of active duty folks here that have kept their properties as investments and everything because they see the appreciation. Like North Carolina, obviously that's where I live. I live in Raleigh. They keep adding jobs and businesses keep coming there. The NC State economist at a Raleigh mortgage makers meeting I was at said when they factor in birth rate, death rate, and relocation rate to Raleigh, it was, or excuse me, the Triangle, which is Raleigh, Durham, and Chapel Hill. It was 89 people a day being added. Well, why is that important? Because even if the economy is not the greatest and housing prices are going up, the rates are high, those 90 people a day, I mean, yes, some of them are minors, children, etc. But those families have to live somewhere. And you have that constant relocation, like into a city that has a good economy or a city that has one of the largest military bases in the world, they're going to have that constant influx and outflux of people. And so that keeps the values up because even if they're seeing decreases in other areas of the country, it's like y'all know, you're in realtors, it's all about location. So it's very location specific where NC is even during the housing crisis, yes, some properties did lose value, but they're darn near double where they were at before. So kind of like a blip on the radar. So I mean, people are still going to find excuses not to make them. That's just the nature of people. All right, when's the crash? Rates are too high. Last year was inflation's too high. Okay, now you got to get out of. I'm worried about the election, and now I'm seeing the new excuses. All right, so inflation is decreasing. Election's over. It is what it is, regardless of what side you're on. But there's still more excuses now. I'm getting that as well. Is the market going to crash? Well, here's the data. I can give you my opinion, but take the data and analyze it as you see fit. And I'll try and find out, send it to you. There's I have a screenshot of the housing record. That's a good, if I don't get it, send it to text.
Okay.
If I forget, I'll try and do it before I leave, but that's a good way to look at it is how appreciation, everything that's worth more.
Yeah, because I always wonder, like, what's the best way to respond to that question? Because, like I said, lately I've been asked that a lot. I guess that's my biggest question. And to be, for my understanding, please tell me if I'm wrong. The interest rates are more near the average than not.
They are historically they are right around average. I think that let me see what the national average is today. So the national average today is 6.75, which historically has been what the average rate was for years. I mean, one thing I don't like is people quote in the 80s, it was a different market. Yes, rates were 12, 13%, but the average cost of a house versus the average household income for 90 days or to 2025. So yes, you could afford that. Now, the average first time home buyer is 36.5 for the dollar, I think was the stat that I saw. So people are waiting longer to buy because of affordability. The other challenge I want to say is we also have a generation of buyers. Like I'm 40, so like people probably 5, 6 years younger than me that bought their first houses. We're spoiled. They came into a 3% market, and that's not the norm. We try to explain that, but people were spoiled. For 4.25 on a 5% down conventional loan was nuts. And now everybody's all rates are too high. It's when it's 6.75. We're getting back more to. Oh, I'm not going to go over all this, but just not to bore everybody with stats, but as we were saying, it's fluctuated slightly, changed mid-6 range. We talked about the Federal Reserve policy. Here's one where industry experts, and one thing is, I didn't put my citations, so all this data is backed up with public knowledge and from people in the field. So 3 to 6 months, they're saying that it's still going to be pretty much static. So people are waiting for rates to drop. And again, we don't have a crystal ball, but the experts take the data that's presented to them and give their expertise and their opinion. they don't see anything moving for 3 to 6 months. Why I wanted to bring that up is if you have people sitting on the fence, y'all are the experts in the value side. So what's that same property going to cost in 6 months as we're now in the spring market? If you're waiting for rates to move just a little bit. So this one I would take with a grain of salt. So by end of 2025, Fannie Mae, which Fannie Mae and Freddie Mac securitize most of the conventional loans in the US. There are private investors. Jordan can go through that. That's the conventional version of Fannie and FHA and VA are secured in it's called a Ginnie Mae. That's the conventional one. So they are literally the closest thing to boots on the ground. And the reason I say take it with a grain of salt, last year, their projections were to be back in the mid high fives. So, in October, we were still in the sevens last year. So they revised it. They're saying 6.3 by the end of the year, which I think that is more realistic. Now, depending on how long the trade war goes on, if the stock market continues to decline, you're probably going to see more people do a flight to the safety, which is buy bonds and mortgage-backed securities, which will bring that interest rate down a little bit. But it's very, very challenging, even for people that look at charts and everything all day to predict what's actually going to happen. And then long term, we just talked about that. The other thing was just easing of monetary policy. So it's a slow process, but we are seeing credit open up a little bit, making it a little bit easier for people to get into mortgages and properties. It's a very small change. Now, I don't want anybody to get confused. Mainly from the consumer side, that means it's easier. The underwriting process is still challenging. It requires a lot of documentation. That's why it's important to get all that up front. But we're seeing that availability increase, which is good because there have been some changes. And prime example are like, where are people getting this info? A lot of the headlines are doom and gloom. So like the FHA changing their rules. I don't know what the logic was behind it, but I'll explain what the rule was. You have to either have a green card or be a US citizen to get an FHA loan starting May 25th. You used to be able to have certain visas, whether they're work visas, non-permanent resident alien, etc. That's been changed. That doesn't mean there's still not options on the conventional or what's called the non-QM side. But that has been a change. It's going to impact a small portion of people. From what I've researched, the idea behind it is if those visas are expired and not renewed, they run up to maybe foreclosure crisis because if the people are food, they can't obviously pay this mortgage. But that's a very high level view. But the reason I bring that up is whenever people get this data, is there another example for Fayetteville? I'm sure everybody was panicking when there's potential government shutdown. The VA does not stop funding loans because they don't fund loans. They just securitize them. The RLC, the regional loan centers are still open. And so that's why it's real important for y'all to coach your clients. If you don't know the answer, reach out to your lending partner, whoever that is, and just ask them. Because when that was rumored, I had a lot of VA pre-approvals there. I got phone call after phone call. I finally did mortgages are not impacted. Sorry, I went off on a tangent there.
Yeah, I needed it.
As we know, market activity as realtors should prepare for increased activity. We're in the spring market and people see rates go down. One thing that we're seeing, not just with a slight rate movement, but as I'm sure you all are seeing, there's lots and lots of demand. There's people that have money to move and they're just tired of waiting it out. But when you look at it when they take a step back, it's like, okay, we were 7.5 on conventional at one point. Now we're down a point. Maybe it's time to re-enter. And people are finally more willing to let go of those 2 and 3% rates. The other thing is, and what I talked about earlier, is unfortunately people carrying so much debt right now, is we're seeing people let go of those rates to cash out refi. So I'll use a real world example. I had a lady that I had her on a 3.25% rate. And she's like, hey, we fell on some tough times due to medical condition. I gotta get out from under this debt. What can you do? I said, well, it's gonna be like a 6.99 rate, but we're gonna pay off all your debt. So your mortgage is gonna go up slightly, but they eliminated literally $4,800 in monthly payments that were making going towards high interest credit cards, personal loans, etc. And how does this correlate to what rates are doing? Is if you have people that could depend on demand and they're so focused on rate right now. I know we're not financial advisors, but question to ask your clients that might be on the fence for selling is, what debts are you carrying? Show them how much equity they have in their property, because what we're also seeing folks do is, even if they're buying a bigger house, or a lot of people are downsizing, if their kids are moving out, they see that as an opportunity rather than just focus on that low rate. All right, if we can get out and make $150,000 on our house, I can pay off all my debts, still have down payment for the new property, and even though I'm going from a 3 to a 6.5, am I still overall financially benefited from this? And a lot of times it's yes. And that's another approach. Obviously, we advise them to do what's best, but it's a way for us to explain property values appreciating versus a crash, and the rate is only one variable for a client to find property.
And if I can rewind like
Yeah.
a minute, how likely do you think we are to get like those super low rates again?
I think
3%.
I would give it less than a 5% chance, but that's
Oh,
my
wow.
opinion. That's just my opinion, because one thing that was learned as anybody that was doing real estate in 2019 and on is that rapid drop put way too much strain on everything. That's what we were seeing. The 100K due diligence is 20% value increases each year. So I mean, they can't control it. There would have to be like an outside factor, like another COVID, another major military conflict. But everybody thought rates would tick down between when the Ukraine and Russian war started, and they did. Even though it didn't directly impact us, I mean, it is at the end of the day impacting us because we're sending money and supplies and everything. So that's why the experts say, and like I said, full disclosure, in my opinion, I don't think they'll ever get back down. I could be completely wrong, but I mean, I remember when rates were high 4s, low 5s. I try and go to as many closings as possible and follow up. And I remember telling clients, just, you need anything, let me know. I'll see you at your next house purchase because you're set with this 4.875 rate. And sure enough, a year later, well, you're 3.25. It's time to pull the trigger because of COVID. So, never say never.
Right.
Yeah, but people, their understanding, interest rates are low, prices are high. I always
Yeah.
explain like a seesaw.
Yeah.
So.
Yeah, it's all supply and
Yeah.
everything.
Yeah, and then, with their low interest rates, so we're seeing people who are overpaid. And so if you purchase this home 2019 for, let's say, 300,000. And so now we're in 2025, and your home value may not be at the price because it's always based upon.
Yeah, it's starting to level out. We saw that great increase. The only ones that I've seen in on any type of decrease was very minimal. And I think it's like you said, it was because they probably went well over what they should have. Because I mean, if y'all remember, we had time adjustments on appraisals. Like if a house comp sold 6 months ago, during those times they were adding line items. Like, oh well, it would be worth 20 grand more or 6 months ago. So I mean, that was the best way to do it. It's a market, and people are more qualified than they have ever been on mortgage. So that's why foreclosure rates are still low. Because the other reason is people have equity, so they're smart and they can fall on hard times, or absolute worst cases they have to be short, so they just sell, where they go from there is hard, but what's good is they don't have that forward motion. Yeah, it's definitely interesting because, like you were saying, like the supply and demand is, it's been all this from certain experts' opinions. It's all finally snowballing from COVID. You can blame both of the past administrations, Republican and Democrat, because when the money got super cheap, it got pumped into the economy, which drove up inflation. And then more and more stimulus is from both of them. But an overinflated supply of money as a market. And that's why we saw record inflation. Now, I haven't flipped the bill for it, unfortunately.
So can prices like, this might be a silly question, but it just came to my mind. Prices like gas prices, egg prices, which I spend almost $10 on eggs. Could that be in any way indicative of what's going on, like in mortgage world?
Yeah, 100%, because that's especially like the egg prices and just food in general. It's a good way when you see those start to tick down. That's a good sign of which way inflation's going.
Okay.
Because, like I said, there's a ton of reports I won't really go into because full disclosure, I'm not an economist, so I don't really understand them. But the way they do the inflation reports, there's like four, and then there's other ones, and they factor in a lot of items into one report, and then one is mainly focused on what impacts us, like grocery, energy, mortgage, etc. And that's a good way to see it, is if you see prices come down, it is a sign that inflation is moving.
Okay.
Any other questions? I rambled for 30 minutes. Sorry. One thing I will say is, and it is a good tool to use. One of our lending partners, they're always on the brink of technology. And one thing that stuck with me that the CEO said is, talking about mortgage originators, it does correlate to you, to realtors as well, is use AI for this stuff as well. You can plug in a lot of data, and if you need like a specific question, of course, I'll leave my information. Y'all can always reach out, but AI is really helpful for analyzing this because it's going to pull so much data from every source, and it's going to cite the sources so you know what you're quoting, like not Joe on Wikipedia, it's CNBC or Fox Business, Analyst, etc., or directly from it's called threat, which is better words, or notes say I have like notes and data in there. So that's one good thing to use. And one thing you said is, right now, LOs will not be, realtors won't be replaced by AI, but who people that use AI versus the ones that don't are the ones that are going to be replaced. I bring that up. So if you do need help on this, give chat at it. If you got a chance at it. You need to try plug in that housing without stability, but yeah, look at that. Sorry. Go ahead.
Like you said that, and I apologize for being late. But, and I don't know if you touched on this, but going back to what you were just saying about resources and not believing everything you see with your, but for the last few weeks, somebody posted this data infographic about how foreclosure, I'm about to say how foreclosure, like, and the amount. I'll share that social media, and everybody was like, "Race for tax." We did as somebody who made it, started my real estate career before the Great Recession. This is something like that, and it was interesting in the teeny tiny top corner. And you looked at it, it said pictures in multifamily. Nobody looked at that.
And it wasn't normal multifamily, it was 5 units and up, which, as we know, is more along the lines of commercial.
Right.
Because we do have lenders, but they're called non-QM lenders. Non-QM lending, for those that don't know what it is, it's non-Fannie Freddie VA FHA USDA.
Also, right.
Yeah. Yeah, now it's because
QM sounds better.
QM, when one of the things that changed with a lot of the rule changes from Dodd-Frank, adding the CFPB, everything like that, which they're not going anywhere. It's what the indications are. Everybody can use them a little bit. Is we have to have what's called a qualified mortgage. It's like an extra layer of qualification that Fannie and Freddie use for costs, rate, et cetera, debt to income. It's basically your overall ability to repay. And so non-QM falls outside that. It's basically the deals that don't fit into our mainstream lending. And that's where some of the 5 unit properties, that's gonna be more commercial and non-QM because only 4 unit or less fall into that. And if you pull the data on that, it's completely different from that high foreclosure rate versus the other. And I haven't dove into that data, but I know a lot of it we're talking about money that is a commercial lender has to do with a lot of these blanket for commercial loans that were done during COVID. Because when they did it during COVID, it was all based off of like treasury notes plus a margin. So those rates were super low if they're adjusted. They're like fixed for a 5, 7, or 10 year period. And now with rates where they're at, you're seeing the notes adjust on some of these commercial and they're not cash flowing. So people can't refinance or they have to sell or they were inflated in value, like you were saying. So that's the big difference. This gentleman works for Housing Wire. You can follow him on Facebook and other platforms. He is one of the few people that is unbiased when it comes to everything, but he will analyze housing trends very, very efficiently. So I'm good enough to be dangerous, but this gentleman is what he does every day. And the reason I bring that up is starting on all the combos. Trying to find, he covered this.
Uh-huh. I just thought it was insane.
Yeah.
People that haven't solved it.
Yeah, so he actually wrote an article on it. No longer delinquency, not sure the housing market, but aren't elevated. He covered on that because of that, there's your chart. So people weren't paying attention to the chart is, oh my God, look at foreclosures are skyrocketing. And it's hard to see, but it's right here. Multi-unit families, and it says in here, it's hard to see on the screen, but 5+ units. And that's why it's important because your clients are seeing this and they don't know how to extrapolate the data. Not that we have to be economic experts, but when you see stuff like this, pay attention to like people like Logan, your loan partners, because we're gonna crush this right away because 1, we don't want to create a panic. 2, I selfishly don't want to take 7 phone calls like I did when the government shutdown was supposed to happen from active duty and veterans. Oh, am I not gonna be able to close? No, sir, you are. No. But not faulting the clients, they don't know any better, they just see headlines.
It's I like you say. Okay. You know, AI does great things. You know, I mean, without a doubt, but at the end of the day, we still have meetings. Turn with the data.
Exactly.
And AI is not going to make it very obvious that hey, we know this property values. Yeah, the data is there. But it's up to us to interpret. And I saw educated realtors reposting this, and I was so disappointed.
I saw loan officers, I'm like, what are you all doing? Because they just saw it like, oh, this is gonna get me likes, it's gonna get me shares, but did you read it?
And creates phone calls for the rest of us, you know, or thinking about selling, or thinking of this, or it's a different thing.
This is your crutch. Yeah, we're waiting for that crash. Yeah.
Trying to learn because it's not to the great thing for her as consumer, they never know what was right. And then we have to not only get them to trust us, but get them to trust the data that we're interpretation. I think a lot of consumers also assume why the crash happened in 2007 and don't really know the underlying reason why it happened. So everyone's just sitting waiting for that to happen again. They think that a $350,000 house is gonna go for $100, but then it's not, you know what I mean? It's just not that situation. It's just a lending issue that was fixed and now here we are. So it's never gonna be that type of market again, that type of crash. So like explaining that to them, you know, and why that crash happened and knowing why that crash happened, I think that a lot of this. I just don't ever see a foreclosure. I mean, I was in business then and it was foreclosure after foreclosure, short sale. So you rarely showed a house that was with the seller, that wasn't, you know, bank involved. I really feel like it's like that for a long time, and so I just think it's like differentiating, differentiating that I would say.
I believe that's right. I'm picking up what you're putting there.
With those two. The way it did in 2007.
I have a question since we were talking about the government shutdown.
Yeah,
Is another reason that they panic, and I might be wrong, because I remember this from years ago. If there's a government shutdown, does that not impact some of the like active duty and people's pay? Is that might
their military still is supposed to get paid. Some people were put on
like some
furlough.
years
Yeah.
ago
When
where
people were put on furlough, that's when
Yeah.
they were stopped being paid, and that opened up a big can of worms for people that were under contract.
right,
Because all of a sudden, we're doing our final verbal verification of employment, and it comes back that they're furloughed, well, their income's gone. And it's not like we wanna be negative, we all wanna
Right.
close the loan, but it's with our rules and our fiduciary duty, we're not putting somebody in a house that doesn't have income, that's gonna lead to
Right.
them becoming a foreclosure statistic.
I was.
But that's when people were furloughed, normally the
Okay.
only impact, and I'm not sure if it still is an impact anymore with government shutdown, is the USDA office. So if y'all are familiar with USDA, we underwrite it, you get everything good, the underwriter's like, oh, this is perfect, and they send it off to USDA for like their blessing. That was impacted last time, but I think they may have put a carve out.
Okay.
And this is, I did find it, I'll share this with y'all. When you talk about the crash, and it's a little blurry on the screen, but, I did give an incorrect stat earlier, so. 90 and 91 is when we saw either zero or back to back without appreciation, in 2007 to 11. And this is basically, we're talking about what foreclosure is. All those properties were inflated. But still, you can see here, coming out of COVID 11, and this is not showing up, this is for the housing crisis. This is when we had to cheat money in 100K due diligence and appraisal addendums, time adjustments. That's when we saw the crazy 19%, but this is more along the lines of normal, especially for North Carolina. It's at 4 to 6% range.
And you say you'll send me.
Yeah, I'll send it. But yeah, that's where this comes into play. And that's another, we need data like Logan's did. This is data from Case Shiller. They do a lot of research on this, but this stat is from Barry DeLeven, mortgage backed. It's MBS Highway. You all know who Barry is. He's like known as the renowned expert in rate prediction. He speaks nationally at conferences, both retail broker, like he'll go speak at Rocket, then to a group of brokers like me. He's a good person to follow, but he's even admitted he's been wrong the past, like, Habib, HABIB.
Yes.
But he's been wrong, but at the end of the day, I think I can touch on it briefly, is they can only analyze the data that's in front of them, and so when they go back and amend data, it changes with the predictions to the key.
Yeah, the question. Yeah, just a little bit out there, the FHA, which you talked about earlier, the rules that they had to set out. Are y'all having any loans that y'all having to go back because of the down payment assistance? I did ask my friend on that, but she was saying it's not a state limit.
So yeah,
Those
but
loans are not affected.
So with FHA, it was just a visa change. You have to either be holding a valid green card or be a US citizens, like those HB1, L1 visas are the ones that are ineligible. Basically work visas are what's called non-permanent resident alien ones. Most FHA DPA is done by third parties. So I'm a true mortgage broker. I work with like 20 different banks. That's people ask like what products you have. It's easier for me to say what I don't have. I don't have NC housing because that's their they only want to work with lenders, not brokers. Long story, I don't know why, but the reason I bring that up is that's not impacted by any of the changes because that NCHFA is a different pool of money and it's just basically tacked onto a conventional or FHA. The conventional ones I changed are a very, very small carve out for super low income people. And some are actually regionally based, like underserved areas. Like you'll see cities that have carve outs for those programs, like a lot are around cities that are like Detroit, for example, has a huge carve out. But the normal, like first time home buyer grant programs, those are still active. Like Home Ready, Home Possible inside Fannie and Freddie, those just reduce the cost. They give a small like credit, those are still active. It's the ones that were, I'm gonna check up the acronym, like special purpose, SPCA, AC problems or something, those are the ones that are impacted. Which I've never written one, doesn't mean that they're not popular, I just haven't found anybody that fits that bill. Because the one challenge with those is, because the income limits are so restricted that North Carolina is becoming costly to live in, they're not expensive yet. And people can't qualify for those.
That's more like a convention.
Yeah.
Because they're,
Because they do have income limits
Yeah.
for those programs, like conventional doesn't, but for those specialized programs, they have income limits similar like a USDA. But like prime example is the Raleigh metro area, which I think covers all the way down to like Harnett County and Franklin County, that whole encompass. The USDA income is now $120,000 because they had to adjust for the cost of living in.
do you do a lot of USDA conventional loans? Because most of mine, of course, the one have been too long, but most of everybody qualify for the different take because of those things. Income limits, ratios, and
Yeah.
stuff like that. Is it like, with different lenders? Is it like, is the ratios the same for everybody, like the 43% or, you know?
So on conventional, it's all tied to our automated underwriting software, which is called AES. So we have to take the loan app and the data and plug it in and it gives us yes or no, basically. So a lot of times with conventional on the back end, we can go all the way up to 49%. It won't spit out a approval over 50, but some lenders can put in overlays, which are additional rules and say, oh, we're only gonna do 43. That's more popular with FHA, the overlays, because a lot of times with FHA, you can push that AUS up to 55, 56%, but some lenders will cap it at 45. Like I don't know if they still have it in place, but it was either USA or Navy Fed used to have that cap on VA. VA, as long as you need residual income in the, you have to advise the serviceman or veteran what they're doing, make sure they're good. You can get into like the 60% now range, but some lenders do, and it was one of them used to have it. They may have removed it. It was a 45 back end. So I work with a veteran education group, and so I got turned down. Your loan's fine, and then it's like you shoot an email over that they sent you because its income, its debt to income is 47. It's fine all day. It's got as long as you're good with the payment. Right. A lot of times we'll help them build budget and stuff like that. So like the one grant program we did,
With a personal.
yeah, like that's not impacted because that's an outside grant. So the biggest thing is whoever y'all are working with, if they have these grant programs, just ask them because there's so many different ones.
Yeah.
Like these grant programs I have vary from lender to lender because some of them are like government agencies or funds, but they're completely different. They're separate, like outside NC housing and things like that. Like one we did was a forgivable grant for like $5 grand, which isn't a lot, but it's not repayable. she met the income limits for a ready loan, and so she got the $5,000 in a low rate. Though that's still available if you fit the income bonds.
Credit score. I got no questions.
Yeah.
Credit score, 640 for most, like North Carolina Housing Fund. Do you have any programs that are relevant at 620?
Conventional, we do have 620. It's gonna depend on the overall credit profile and their down payment, because when you get below 640 on conventional, you can say like 5 or 10% down payment. The mortgage insurance is very expensive.
Yeah.
Like mortgage insurance varies on conventional, not FHA. It doesn't matter if you have a 580 with FHA or 800, you get the same MI factor. With conventional, it factors its down payment, and it changes from credit tier to credit tier. There's a lot. Like it used to be 740, it was considered highest, now 760, they go all the way down to 620. So if you have like 660 and up, your MI is going to be pretty darn affordable. You have below that. Like I had one the other day. It's like you might have to look at FHA, but she wanted a house that was about the limit. Her MI was almost $500 per month. That's essentially like a small car payment, just literally nothing. Wow. And I told her, it's like, it's the best I can do. Decisions on you, you qualify, but you can either try and improve the credit, wait a little bit. I give you the options, you make the decision.
Do your company have a resources?
We use a third party. I mean, yes, we do have a REscore, but we use a company called My Credit Guy. And I can introduce you to them. There's so many.
I researched Shell's credit team, but the reason why I asked about that is because that's kind of what I do with most of mine. And that's why I was asking about the 620, 640,
Yeah.
because when it gets to some of that, some be ready to go, but they need to get those other 20 for most of the programs.
Yep.
But I can get it for the 620, so I'm trying to find other people that are giving them 60 status.
Yeah.
So that's why.
So everybody should have access to it. They kind of changed that simulator on us. They used to be super good.
I got it.
And now it's the credit bureaus took it away for some reason, or they gave us polished version that is not as good. But essentially, I can get either like how much disposable money do you have to work with, or give me a score goal. And it's an algorithm that'll figure out the FICO score model to say what you need to do to go from say like a 615 to a 6.
Oh, so like almost like credit repair.
It's a little bit different. This is like credit repair light. Like I can do and say, all right, the simulator says pay this credit card down from $4,000 to $1,000.
Gotcha. Okay.
Add, if you have a husband and wife and they're not like maybe husband's in a credit card from 1991 that's reported on time every time the wife isn't on it. Add her to at least her score. That's when it'll.
Yeah.
Credit repair is when it's above my level of
Gotcha.
intelligence, or you have to fight a bunch of collections and charge-offs. There's certain credit repair companies that are just shady. They just want that monthly payment and they drag it out. I've interviewed a bunch. There's only one I trust is My Credit Guy. They're out of Iowa in Florida, but I've known them for years. The way they do it is they start off by meeting with the rule book, the creditors. They had one where finally one late payment, like something's not right there. They found out that email was addressed, so they hit it in the Fair Credit Reporting Act. You gotta delete this because y'all didn't give them correct notification that they did that. That's like step one, credit repair. Then you start disputing and negotiating after that. That's what they do. Like if there's a charge off, for example, they might go and say, all right, Mr. Capital One, the client owes you $1,500. You settle for $1,000 and repeat this. And a lot of times do it because otherwise it's just sitting there. You need to sold different election agencies, and most people don't know that's it. But that's beyond my level of expertise. That's right. If I really see someone that needs help, that's when I tap them in. Yeah, we can do the easy fix, like credit card monetization, maybe add to a card, etc. or even removed from the chart. That's another one that the simulator will tell you, like maybe it's son's on mom's card and she actually does have a 30-day late because she made a mistake, takes off that card and score sheets them.
Yeah, I'm just on this.
Thank you so much.
Absolutely, yeah, thanks for.
You crushed it with Chick-fil-A. Selfishly, I'm always like, well, if you bring Chick-fil-A, no one will be back.